We are honored to have Tammy on. Tammy, I hope you're doing well, and I will hand it over to you.
Doing well, thank you. Welcome, everyone. I've been trading M.E.I.C for about a year and a half and been trading zero DTE for probably 4 or 5 years. This is a chart of my return year to date. I trade three accounts, and this is all accounts combined. So you can tell it's been a pretty good strategy this year, even though it's had some ups and downs. There are little drawdowns in there. I wanted to say that what I am showing in these sessions is how I do things and how I make decisions, why I do certain things. And the goal is for you to understand my reasoning behind that. I have failed as an instructor if you just copy me. I want you to be able to make your own decisions for your own reasons about why and how you're trading. I always try to say there are other ways to trade this and other successful ways. My way may not be the very best way, too. There are people that are probably making more money than I am. I am pretty conservative in my trading. I make decisions based on that. I don't like drawdowns. I don't like high risk. So I try to limit those in my trading. You can decide what makes sense for you in your trading and your risk tolerance. And it may be different than what I'm doing, which is fine. And it's probably good. So Troy said this class is for informational purposes only. It's not to be investment advice and not intended to be investment advice. Any trades you make based on this information are your responsibility, and I disclaim any liability, loss, or risk resulting directly or indirectly from the use or application of any contents of this presentation. First of all, I'll just talk about drawdown a little bit. How drawdown is defined is it's not just one day's loss or one big loss in one day. It is a series. You can have a series of losses and then some gains within there, but it's from the most recent high to the low and then back to where you recover that recent high. So that is the drawdown period, and that is the max drawdown. That's how it's officially defined if you look that up on Google. And we are live trading here, and I did get stopped out. So I am going to go check that quick and see which position I got stopped out of. It wasn't that one. It was this one, and I'm going to mark that down. Here, I'll show you, try to keep this live as much as possible. That was the 45.85 call, 362, 122, 4240, and the time was 11:07 Eastern time. So that's two stops. So these are the trades I've entered so far today, and I will be showing live trading. And I've got three accounts I'm trading, and I've entered two positions so far, and I'll enter another one while we're in this class at 11 o'clock. So just to cover the most basic principles about M.E.I.C, multiple entry iron condors. Those are trades that I used to trade just entering in the morning and kind of going all in, doing all my contracts in the one entry and putting a stop of 3 times the initial credit for a 2x net stop on it and just playing it out for the day. The advantage of multiple entry on condors is you don't have all your eggs in one basket. Like I've gotten stopped out on some trades here, you could see, but I haven't in others. And so it all balances out. And it's a good way to average your bets and not put all your eggs in one basket. So what I do is I divide up the amount of buying power I want to use or amount of risk that I want to take in a day. And I divide that into 5 tranches, 6 tranches. It depends on what the times show and what my account size is and things like that. So So I'm usually entering 5 or 6 tranches, and I decide in advance. Usually, I decide at the end of every month, I do an analysis on what were the best entry times. And I can call that up. What were the best entry times over the last month, over the last 6 months, and over the last 2 or 3 years? And I look at that once a month because what worked last month might not work this month. And I do all these analysis, and this takes about a day to put all this together. And then I summarize everything, and I post this in Facebook and the Quantum Options Facebook group and Quantum Options Discord group. And if you want to follow my trading results, I post results every day in those two groups. Quantum Options Facebook group, you should just be able to search it on Facebook and find it. The Quantum Options Discord group, I'll send a link out to everybody by email. Or I'll do both the link to the Facebook group and the link to the Discord group. And so you all have that and can join if you want. So you can follow along results. I think people can learn just by comparing what you're doing to what I'm doing. And sometimes you'll do better, sometimes I'll do better, but we can all learn from each other. I can learn from anybody who is willing to share their information. So what I do is enter into a iron condor, and I'll either leg in. Some people will enter the whole iron condor at once, but you can't control the prices you get on each side based on that. So I will usually leg into the iron condor, and I'll enter the side we're moving away from first. So I'll enter the side we're moving away from first. Like if I was to enter one right now, I would probably tend to enter the call side first and then the put side. But if we get a big green candle, I'd enter the put side first. So these are some trades I entered. I haven't marked on here the other trades that I've entered, but I've got a couple more in here. And I usually enter these for a credit of anywhere usually around $1.20 to $1.60, something like that, in that range. And you can see on this, like today I've gotten $1.40, $1.30. On these, I got $1.70 and 65, but somewhere in that range. The mornings I get higher credits, and the afternoons lower credits. And then I usually sell between a 10 wide and a 30 wide spread, sometimes wider, but I'm looking to get similar credits on both sides. That way, if I stop out on one side, my loss is covered by the other side. And I set the stop at a 1x stop, 2 times the initial credit for a 1x net stop. There are certain things about zero DTE, toward the end of the day, you need to convert your stops on the spread to just on the short leg, because if you have a stop on a spread and the long leg is worthless or worth less than 5 cents, that order won't fill. So that's unique to zero DTE, or really it would apply to any spread, but zero DTE, it happens a lot. So anyway, so I'm going to talk a little bit about what I do when I'm starting the day to trading. Like, first of all, I look to see how choppy the market is. Let me go over here. I look at forexfactory.com. If you all aren't familiar with that, take a look, because it's very good at giving you what announcements are coming up and what timing they are. Like today, we had a couple of announcements at 9 a.m. and then one that came out 9:09 that were impactful on the market. I had scheduled this month to enter trades right at the open, 8:33 Central Time, 9:33 Eastern. But because these notices were coming out, or announcements were coming out, I avoided trading those entries and just entered the 9:15 and then 9:45 trade. And it looks like I'm getting stopped out again. So I'm going to go record these. So this one I got stopped out at to 80, and I tend to mark that's 15 cents of slippage. Let me go. This is Trade Automation Toolbox. Call it TAT for short, if you're not familiar with that. And we'll be talking about this next week, the automated trading. And I did get stopped out. I heard the beeps on a couple of others. It's 11:17. Last month I was entering at 9:15 and then 11:45, 12:45, 1:15, times like that. And I think in the video I was only entering afternoon trades. It really depends on my back testing, and I'll go into the back testing next week. This week I'm just going to talk about entries and stops and things like that. But I base it on back testing and what's working well most recently. And it does tend to change. What's working does tend to move around from time to time. So that's why sometimes, like when I started trading this, noon and after were working great. And so I would just avoid mornings. Then all of a sudden, the midday trades just stopped working. And I was doing some testing, and yeah, they just weren't working anymore. And the late day trades were working, and the earlier morning trades were working. And so I would adjust my entry times. Now, I don't, you're chasing your tail if you back test too often and you try to fine tune that. I'm just looking generally for what times are positive. And like in this, any positive time I'm good with. I'm trying to avoid these times where we're getting negative entries like in here. So I don't enter those usually, and just enter, like this is this month's testing, which I just did this weekend. So the green shows the best entry times. And so that's what I'm tending to use. And I'll use other times if they're positive. Like today, I'm going to do a trade at 11 a.m. Central or 12 noon Eastern time, just to show you how I enter a trade. When a market is choppy is when it's moving, I'd say more than 20 points. Like here, I would tend to avoid this, but then it settled down, which is why I decided to go ahead and enter my 9:15 trade. Now, I may regret that because it does look choppy today with the news we had. I may decide not to enter all my entries, just let what I've got on play out, or we'll see. If it settles down later, then I would enter. An ideal day, ideally, if it's trading within a range, it can be 5 or 10 points and still do okay. But when we're moving like we've moved today, 25 points from the low to the high, that's starting to get pretty choppy. But of course, I didn't know that at the time here when I entered. I could have seen, but smoother within a 10-point range is better. But sometimes you just don't know. You've got to play it out however it falls. And so I look at Forex Factory, I look at how choppy the market is. I look for any other red flags that might be in the news that might not show up on the economic calendars. If something's going on with the debt ceiling and Congress is going to vote, or it's uncertain and that's likely to impact the market, or there's some political news or some chance of war somewhere, or something big is going on, I may avoid trading those days. But I've found usually I think it's better to trade more days than fewer days. Yeah, you may avoid some bad days, but you can also, by not trading on a day that you think might be choppy, you can avoid a really good result. So you wouldn't have the good results too. That's just a kind of a gut feel, and you have to rely on your own information and your own thoughts and about trading this. So today it may be too choppy. I probably wouldn't have entered. If I was entering this afternoon, I'd wait and see if it settled down first before entering. And if it didn't, I wouldn't enter. But if it did settle down, I'd go ahead and enter, because the mornings can be different than the afternoons in this strategy. when I'm entering a trade, I will look to see, like I said, what direction we're generally heading in, and even down to the 1 minute candle, what direction are we heading in? Right now, we've gone up, but we've got a red candle. So I might enter calls if I was entering right now, and then I'd enter the put side. Someone asked, do I enter different times on different days of the week? No, I don't. I use the same times on every day of the week unless there is some news coming out. Like Thursdays generally tend to have more, like CPI comes out on Thursdays and some other news comes out on Thursdays. And usually Thursdays, for whatever reason, aren't good days for this strategy. And I think it's usually news related. So sometimes I'll trade on Thursday if things seem pretty calm, or sometimes I'll just not trade Thursday and take the day off. This is a pretty intense strategy because you're entering multiple times a day. You're watching the market. You're marking when you stop out, logging your trades in. One of the things I want to talk about is deciding what size trades you should enter based on your account size. And here's someone, I'll stop just a second and pick up questions as I see them in chat. Austin asks, what's the best tool to use when looking at candles? I just have a 1 minute chart on. You can use whatever tools in addition to that you want. I just have this 1 minute chart. I also look at VOL SPD. It's and toss, you call it up with a $ VOL SPD. That just shows you what direction the volume is going in. And it mostly tracks with what's going on in the stock, but sometimes it can offer a little insight. Like now we've got some good up volume and we're heading up. So it's very simple. I don't use a lot of indicators and a lot of tools, just a 1 minute chart on SPX. And just to decide what quantity to enter, I'm going to show you. Let me call this up. Open browse. I have a couple of tools that I use to determine the size of my trades, and I will email these to you after this class. Class 1, drawdown and tranche calculators. So this tranche calculator, I mentioned this in the video, so you've probably seen this before if you've seen the videos. You would enter the size of your account here. And then usually I don't recommend trading more than 50% of your buying power. That's probably not going to be the limiting factor here. If you're trading a small account smaller than 50,000, it could be. But I recommend not ever risking more than 50% of your buying power in any one trade, on any one trading day. And that's because with options trading, black swans can happen and affect something. Let's say a nuclear bomb went off and North Korea set it off and they shut the markets down. Then and they don't open until 2 or 3 days, which happened in COVID. They didn't open. That happened in 9/11, but in COVID they would shut it down if the market spiked 7.5%. It reaches the shut off trigger that they have set up now in the markets, and they would just shut the market down and then they'd reopen it a little later. In case of a black swan, you wouldn't ever want to lose more than 50% of your account, so you could still trade the next day. So that's a big protection against a huge black swan. So don't go too high on your buying power. Like with stocks, the stock market can close and they reopen and your stocks will still have some value. With options, that's not necessarily true. The options may not have any value at the end of the day, and or prices may spike up and you've lost a bunch of money. You never want to risk more than 50% of your account. Then you decide how many tranches you want to enter. Let's say 5, and the number of contracts 1, and the width of your spread 25 wide. and I'm getting, let's say, an average credit of 130 per contract. And you'll gain a feel for this over time. For now, I'd use 130. You can trade this smaller, like a dollar, have a dollar average contract. And in fact, in this case, if you aim for a dollar average credit, then let your max risk, if you lost on every trade you entered, every contract you entered, and all five tranches, your loss would be 2% of your account. So that's a 3% is what I say is a maximum risk. And that's if you lost on every trade on your account. So this figure is based on how many tranches you're entering and how many contracts you're entering, what your risk is, and the average size contract. So you don't want to trade too big for your account size because you can have several losses in a row. I've had probably 3 or 4 losses in a row, and that can hurt in an account if you're losing that kind of money in every trade. Now, most days you're not going to lose that much. Most days you're going to have a few stop outs, a few break evens, and some winners. And this is protecting you from worst case scenarios. So let's do this back to 5. Now, if you have a larger account, it gives you a little more flexibility. Like I only trade about 25% of my buying power. And so and now we can start to see, I can enter, I'm only risking 1.3% of my account. That I may be fine with that if that's all I want to risk, but I could change that and enter 5 tranches at 2 contracts, or even 4 tranches at 2 contracts and keep it around 2% if I wanted, or enter 6 tranches at 1 contract and I'm only risking 1.6. So that's pretty good too. Again, it's all hinging on what credit I'm using. Let's see if I use 150 average credit, trading a little bigger, a little closer to the money, the max loss is 2%. So that's generally how this works and how I use this to gauge my trading size. And I trade larger accounts. They've grown over time too, and so I use this every so often as my account grows. I'll double check what the number of contracts I'm using and the risk I'm taking and determine how big I want to trade. In this case, like here, I get a message, no, reduce the number of contracts or the tranches. That's because I set the maximum buying power to 25%. With the smaller buying power, you're going to have to use more, smaller account, you're going to have to use more of your buying power. And if I say I don't want to use more than 50% with that number of tranches and that number of contracts and that spread width, then that spread width really helps determine the buying power. So I'm going to send this to you and you can play with it. One other calculator I'm going to send you is this drawdown calculator. This is handy to use for big picture money management for your account. And it doesn't just apply to me. So you could use this for how much. We've set this up just for me, but you could use it for other things. I've got it set so that the max drawdown allowed in my account is 25%. Now that's a pretty big drawdown. If you traded options, you probably experienced something like that. But let's say we set it up with $50,000 account equity. You fill in the info on the yellow cells. This would say at 130, 25 width, don't trade any contracts. They just don't have enough buying power. So I'd have to reduce the number of tranches. And that would say, okay, it's okay to trade 1 tranche at that credit. Now I can reduce that credit to $1 and trade more tranches. Nope, that won't even let me. So I go between the two to determine how much buying power. Let's put in a couple of hypothetical dates in here. Let's say on 2/1, my account went up to 100,000. I doubt that would happen, a 100% increase in a month, but let's just play it out here. So that I could trade 2 contracts at spread width. You can also reduce your spread width to that will increase the number of contracts you're trading because it reduces the buying power. But again, check the risk per day because that, in my mind, that 3.9 would be too much risk to take on that. If I was trading $1, it might be better. 3, it's borderline. But just for hypothetical purposes, I'm just going to enter some values. Let's say 150,000 just to show how this works. And 120, let's say in 5 contracts at 25. I'm going to do 25 wide again because that's 25 is about the max. I'll go less than that, but 25 or 30 with spread width of 25 or 30 is about what I do. Okay, so let's say 4-1, we go down to 120,000 and let's say one. So it's telling me I shouldn't trade. I've got to adjust something. Go to 20 wide, go to 4 tranches. With that kind of drawdown, that's a 20% drawdown. So it's protecting me from going to 25% drawdown. So it looks like nothing I can do with that kind of drawdown. So let's make it, let's say we had a drawdown of less than that, 100 of 6.7%. Now it's telling me I can trade 3 contracts. My risk is less than 2. So what this does is it will reduce the number of contracts based on the size of your drawdown, with the intent of your drawdown never exceeding 25% in your account. I like to use this in that when I start losing money, I reduce the number of contracts I'm trading. So I don't continue to trade the higher number of contracts. I start reducing it. And this is just a good double check. So let's see a 5. Then everything went from 3 to 2 contracts, and 120, it's still 2 contracts. So you can play around with this. Dan Yaklin came up with this, and I really like it just to give me a big picture on my account size, and it's a double check. Sometimes it will have me trading more contracts than I really would want to trade based on the M.E.I.C tranche calculator. These are both in the same Excel file, and you get to each one of them just by clicking on the tabs at the bottom. Go back to the tranche calculator. Let's do 1, and we're doing 5 tranches, 20 wide spread. So let's see what this says. 140,000, 5 tranches, 20 width, and 120. So let's see, 3, that's 2.6%, 2 contracts, 1.7. So you can decide if you want to go a little bit over 2% risk or keep it down less than 2% risk. I'd say if I'd had a drawdown, I'd keep it on the low side. That's generally how I'm using this. The nice thing with M.E.I.C, M-E-I-C, I call it M.E.I.C sometimes just for short, is that if you trade using these rules, your drawdowns will be very low. You will have losing days, but you won't have many losing days in a row. And let me show you, this is one of my trade logs, and we'll get into trade logs probably in session 3, but I'm gonna run a filter on this. That's what I want to run. Here, I summarize the end of the day and put that in orange. So you can see, like recently, I've had some losses. They're not all, it's 2 days in a row, 2 days in a row. There's one where there's 3 smaller losses, 3 days in a row. But they're just interspersed between many winning days too. It's been a very good strategy with very low drawdown. I keep a running total of my account size here. So I am a little less than I said in that calculator, but so it could be a good time to go back and check. And here, using this, I can filter it by days of the week and see what days of the week are more profitable than other days of the week and do all kinds of calculations. So I'm going to take that filter off. Let's look at what the chart is doing. It's kind of settling down. It may be a good time to go ahead and try entering a trade. I was going to do it at 11, but I can go ahead and do that now. Like I said, I look to see which way the market is going, what direction, even within the last few minutes, it's going. And then I use E-Trade. If you use, oh, someone asked, do I make any adjustments during low VIX times? The only thing I might do in low VIX times is use a lower credit target. I don't stop trading. My idea is that, or my philosophy is that options are always perfectly priced for whatever volatility we have and the risk in the market. But as volatility goes down, premiums go down. So you just can't get the juicy premiums unless you're right at the money. So I usually, when I'm selecting strikes, I don't usually look at delta. I look at the credit target. But I may sometimes, if I'm right at the money and going with my credit target, for me, that's just too close to trade. So let me call up Power E Trade here. It looks like I've gotten stopped out of a few today. But so here's an option chain for today. And if I wanted to, let me jump back at that. We're heading up. So I will look at the put side. I'm just going to enter one contract too, because this isn't my normal entry time. So what I do, I generally go for about $1.25 to $1.50 credit, $1.60 credit sometimes. So I'll select a short strike that has more than that credit, and then select the long and see if it falls around $1.30. And then I'll glance over. So that did, like I wouldn't, you could also get probably a $1.30 credit by doing something like this, but that to me is just too close to the money. So I'd rather be a little further away from the money and a little lower credit. And let me change, I'm going to cancel that and let me change a setting here. Just to one contract. Save. So I select the short strike first that's at or higher than my credit target. And then I select the long strike to get within that credit target. Now I'm going to go look at the chart again. So we're still heading down. So if we're heading down, I want to do the call side. Let me just cancel this order. It's not an order yet, but so on the call side, I'd look something over $1, 160, and then select my short strike. So that gives me $1.45, $1.40. And then I'll just go ahead and enter that. I know I can get somewhere close to that on the other side. So then we see what $1.30, $1.25. So that one's moving away from me. I'm just going to cancel it. Let's see what's going on with yeah, it's moving down. So let's try another time here. 145 and 20, 35, 40. If it goes down, I may chase it a little bit. Send, adjust the order to 135. If I order 130, that's probably as low as I'll go. So it tells me the market's moving down away from this. So that one filled. So I'm going to write this down, 147 and 17. So I got it for 130, the 45, 80, and 4,600 strikes. Okay. So then I go here, I'm going to go ahead and set a stop just because I'm not. To set my stop in E-Trade, I just copy the original order, flip the buy and the sell, and then select market debit that or stop debit. That's a market order. I used to use stop limit orders, but now it's pretty safe to use market stop orders. So that 250, and I'll explain the stops a little bit. Let me enter this side. So here, let me check where we are. Yeah, we're moving down. Sometimes I can wait and see if we get big red candles. I can wait a few minutes and see. In my calls at 80. So that would be right around there. And then I can wait until this kind of pauses. Still going down a little bit. So there we get a green candle. So that may be my sign to enter. Then I try to get, let's see, 130. Like I got 130 credit on the other side. So, well, look here, it's working out. So the market must be going down again. So I got 130 on the other side. I'm going to go ahead and enter that order for 130. So I just select the strike that's greater than, so that one filled 160 and 30. So I got in for 130 on that side. And then I'll set the stop. I flip the order around. Other brokerages, you might have to do this different ways. And then 250. I got 130 credit for that trade. A 1x stop would be 2 times the initial credit, 260. That would be perfectly fine if you use that. For M.E.I.C plus, M.E.I.C plus, the goal is to, if you stop out on one side, so many of these trades, like roughly 35% of the trades will end up at break even. And the idea behind M.E.I.C plus is that since so many of them end up at break even, if I can make a little bit of money on those 35% of the trades, then I can just improve my bottom line. So I tighten the stop by 10 cents less than 2 times the initial credit. So here, that initial credit was 130. So 2 times 130 would be 260 to set the stop. And that's fine if you want to do that. I set it for slightly less, so 250 on each side. So if I get stopped out on one side, then I will make 10 bucks on the trade. So one side stops out for 125. And yes, Chris, I do get consistently less than 10 cent slippage in E-Trade. E-Trade, most often I get out right at my stop. And some brokerages differ. If you're at a brokerage like IBKR that has high slippage, you might want to increase that to cover your average slippage and a little bit more. Like let me open up TAT here. You can see these trades are set up a little bit differently, but let's see, I had an 11 o'clock trade there. So we've got one trade coming on at 11 here. These are set up because the credits are different, so different. What I do there, and this is a setting in TAT, I add the 2 credits that I get together. And so like here it would be 160 plus 135, and that would be 295. And then I subtract 20 cents to cover the slippage plus a little bit. For IBKR, I average about 15 cents average slippage. This gives me a little bit better. Like here, you can see I had 10 cent slippage on that one, and I had 15 cent slippage on this stop out. Over the hundreds of trades that I've done this year, my average is about 15 cents slippage. So I set that for a little bit less than the slippage plus the offset that I want to use. So the downside of this is you are tightening the stop, so it may stop you out slightly sooner than if you used a 1x stop. But the benefit is that it usually will cover your slippage too. So you'll often get out, at least in IBKR, you'll often get out where you really wanted to get out. This credit was 160, so the stop would have been a 2x stop would have been 320. So that stop is tight. The stop is tightened quite a bit from a 1x stop. But because in the M.E.I.C plus techniques, I want to get similar credits on both sides so that if I stop out on one side, my loss is covered by the gain on the other side, because the majority of the trades will just stop out on one side. You will have trades that stop out on both sides. I think there's about of the iron condors, about 5% of them stop out on both sides. And, or of the total trades, about 10% stop out on both sides. So it's a pretty low percentage that stop out on both sides. It does happen. And some days it happens a lot. Some days it happens none. So, I'm not saying it doesn't happen, but it generally both M.E.I.C and M.E.I.C plus being the reduce your stop slightly off of a 2x stop. Both of those will generally work, but I have found in comparing it to just trading straight IC using a 2x stop or a 2x, two times the initial credit for a 1x next stop, that will uh, it keeps my drawdowns low. It keeps my returns pretty high. It protects me from any huge losses and gives me results like this in trading. So that's a pretty good equity curve. And it looks like I entered another trade here in TAT. So I'm going to mark this one down, 45.70, 45.75. 45.55, 45.45, 1.48, and 1.47. So you can see there, the credits it got were very similar on both sides. Two times, let's take the 147, 2 times 147 would be 294 stop. In TAT, I subtract 20 cents from that. It set it at 275. Actually, what it's doing is adding these two credits together, 148 plus 147, and then subtracting 20 cents. Now, if this was my regular account and not TAT, I would just subtract 10 cents. I would set the stop at 285. So what's the disadvantage to moving the long leg down to 5 cents to maximize the credit? I have found that the tighter spreads, actually, that long leg can protect you from stopping out. If I have two trades and one is let's say a 25 wide and one is a 50 wide, the 50 wide may stop out first because that long leg it loses value faster. And very often, like I had, I think I took a screenshot of this yesterday and saved it so I could show you guys. Let me scroll down and find it. Yeah, here's one. I went further out, and these were probably 20 or 25 wide spreads. I was a little bit further out of the money and had a wider spread on these. And in this move, this trade was, I think it was only a 5 wide spread, and these were 15 and 25 wide spreads. I collected 138 on this spread, and I'll collect different amounts just based on when I entered because I can't enter everything at the same time. These spreads I collected, I decided rather than it was starting to move down and I was getting too little of credit. So I decided to go further out and trade a few more contracts. So I increased the number of contracts, got less credit. These are 95-cent credit and $1.10 credit, but I increased the number of contracts so that I was getting the same credit on both sides. And interestingly enough, these stopped out, even though this trade was in the money. That long put added in value so that the difference between the spreads was protecting me from that being in the money. And it turns out that I don't think that ended up stopping out the whole day. Like the stock after this went back up, and that one was safe the rest of the day. So that's the reason I trade. One of the reasons I trade tighter spreads. The other reason I'll trade tighter spreads is because I can trade more contracts. Now, I do that because I'm only using 25% of my buying power. So I know that if I want to double up on contracts, I've got plenty of buying power. If you have less buying power or a smaller account, you may not be able to do that. And you'd have to be more careful. But with a larger account, more buying power, I've got a little more flexibility because I don't use anywhere near the max amount of buying power that I want to use. And let's see, someone else, Mark asked, what made you decide to focus on credit versus delta? And basically, they do very similar things. I determined my credit target just through back testing, what back tests the best. And what I have found is that higher credits back test better than the lower credits. Like you'll see in those tests that I've done, um, consistently. Let me go up here. Here's 220. I test getting average of 220 max credit. So the actual credit is less. Since that's max credit, the actual credit's always less than that. And my average of the 8 best times using Calmar is 80. 180 tests a little better this time, not doesn't always, but this time to 126 for the 6 or 8 best times. Then 150 credit is a little less at 78 Calmar, 120 credit. So I test a bunch of credits. I usually don't test below $1 because I don't go below $1. I've just found out those stop out too fast. Like any little movement tends to stop those out. But so doing studies like this have showed me that trading in this $1.20 to $1.40 credit size average works pretty darn well to max out the efficiency. So that's and if I traded delta, it would be very similar because credit, by targeting credit, what happens is you'll be a certain distance from the money, and if you go further out, you're a little less credit. Same thing with delta. The delta will be higher the closer you are. And I have found that most of the time in the mornings, I'm trading around delta 16. I didn't happen to notice what delta we were trading here, but let's just go look at what it is. So right now, this trade that I just entered, let me 45. That's delta 10 down there. It wasn't at the time, and delta 17 here. So I found in the mornings, I'm usually delta 12 to 15 earlier in the morning, delta 16 or so midday, and it can be delta 20 or 30 late in the day for those credits. So it moves up. But I do reduce my credit target in the afternoon. So essentially, I am reducing the delta a little bit. I've just found it's easier. I test using the credit target, and I've just found that that gives me pretty good results. And it would be very similar if you used delta consistently, and delta would reduce, I guess, as later in the day, these deltas are going to become smaller and smaller as you get closer to the money. The closest to the money will be 50, but these are going to reduce. So it'll also naturally pull you closer to the money toward the end of the day, trading lower deltas. But it's also, I did not develop this strategy. I learned this strategy from Dan Yaklin and Kyle Leesman. And Kyle developed some of the backtesting tools that I'll show you tomorrow. I'll also show you how to test this on option Omega. But this is how I learned it and just how I trade it. It could be that you can develop this strategy based on Delta and aim for Delta 16 all day long if you like. Something like that would be perfectly fine. Let's see, do I factor in commission when considering contract size or number of tranches? Um, the only reason I would do that is my goal is to get the lowest commission I can. And I know that E-Trade, it's a flat commission across any number of contracts. Tasty Trade, I think you get a break on their fees. You don't get a break on the CBOE fees if you trade more than 10 contracts. But IBKR, if you trade one contract, they charge you a high fee. And if you trade two contracts or more, they charge you a slightly less fee. It's still pretty high. I think IBKR's fees for SPX are some of the highest in the industry that I've seen. I don't usually factor in commissions, but I do. Like when I learned that when I was first starting TAT, I decided I didn't want to try it with just one contract because of those commissions. So I started with two contracts in TAT and just to get slightly lower commissions. But the commissions do add up. This is a commission intensive strategy because I'd say they're probably 20-25% of the total gain that I've made. That's what the commissions equal over the past year in my experience. Okay, I'm going to talk about stops a little bit. And let me go back to one of my, this one's easy to use because it's just easy to explain. And yes, the longs would still be worth money. I usually set the stop on the spread because for me, entering in three accounts, it's too much to manage if I tried to just set the stops on the short leg and then close the long legs. I'd have to try to figure out very quickly which long leg belonged to that short leg. And that's difficult to do in the way I'm trading it. If you're just trading one account, yes, you could set the stop on the short and then close the longs if they had value. But I just try to make it easy on myself. It's enough to manage just with managing the entries, the multiple entries and multiple stops through the day, trying to keep track of which ones stopped out, which ones I'm entering, what time am I entering, that kind of thing. That's yes, the longs. I manage these as a spread until the end of the day. And anybody who's traded zero DTE knows that you've got to convert your stops on spreads to stops on the short once that long leg gets worth less than 5 cents. So let's set up some trades here. Let me just 40. It really doesn't matter on the strikes, but I'm just going to give it a strike value here, 172, because, oops. And then I got 32 cents for the long. This was 46.05. So that was a 20 wide. And again, I don't pay much attention to the spread width when I'm entering. I am paying attention to, are the credits similar? And in this case, ideally, I'm going to enter, ideally, it would be, let's say 197 and 0.57. So ideally, it would be just like this. And I would set my stop for 270. I take the credit, double it, and subtract 10 cents. So the stop on this, let's say I got stopped out on that at 270. I'm just going to put the total stop in there. That way, if I win on one side and lose on the other, I made $30 roughly on that trade, even though I stopped out, assuming that those puts are good the rest of the day, that I don't stop out of those later. If I do, that stop is also 270, and my loss is slightly less than a 2x loss. So you could look at it that way. But so let's say I don't get similar credits. Let's say I get less credit on the put side than on the call side. I've got 140 credit on the call, 130 credit on the puts. What I'll do in that case is usually what I'll do, if they're that close, I'll set the credit, the stop for 250 on the low side. And so if I stopped out on that low side, you can see I'd make $100 or so. I could do and if I stopped out on the high side, let's say 250, then I've made $50 on that trade. I also do the thing where I combine the credits, like 130 plus 140, 270, and subtract 10 cents, 260, and set that as the stop for each side. So that if I get stopped out on that side, whoops, 260, then I made $50 or so, $30 on that side. And if I get stopped out at 260 on this, I've made $30 or so on that trade. So that's the idea behind M.E.I.C Plus, and that's one way to handle it. Now, let's say I get very different credits. Let's say 220, I don't know what that's going to be, but 165 and 140. That's definitely a case. Now, at this point, I may decide to trade 5 contracts of the smaller side. So let's see if that gets me closer to. So that makes the total credit closer. $70 and 640. That's closer to the similar credit than trading 4 contracts of both. So sometimes if I do collect a lot on one side and I'm just not able to get that on the other side, when I'm entering, I may set it up so that if I can get a trade for, let's say, 160, that I get those very close together if I adjust my spread. So it's another advantage of legging in. I've got the knowledge of what I got into the other side for, and then I can adjust the width or the credit, whatever I can do, or the number of contracts to get those credits closer together. If I get these closer together, then I will go ahead and set this one up for 2 times the initial credit less 10 cents. So that would be 250. So if I stop out on that side, then I collect roughly $50. And then I'll set it for 2 times the initial credit on this side. 165 times 2 would be 330, less 10 cents would be 320. And so there, I collect $10 or so. And sometimes I could even do that less, like 310, and get a little more collect a little more if one side stops out. The idea behind M.E.I.C Plus is always to get similar credits, and I can do that by adjusting the number of contracts on one side and the credit on one side so that the total credit matches. Or if they don't, then I can adjust, let's say 7, 7. If I can get them equal, great. That's ideal. And most often I am able to get them within $5 or 5 cents of each other. And that's close enough for me. And I'll usually set, let's say I get 167 on one side. I will go ahead and set the stop on this side for the same as the stop on this side. So that would be 250. And if I stop out, then I get $50. And if I stop out on this side, I get roughly $50. So it's the same difference. So M.E.I.C Plus is all about making money off of those break-even trades because there are so many of them. I have a handout that I'm going to send you. And this handout will show you like the basic M.E.I.C strategy, just setting your stop at 2 times the initial credit. Then for M.E.I.C Plus, it's to turn our break-even trades into small winners. And the various ways. If you get the same credit, it's easy. If you get similar credits, then you can set the stop for the same on both sides. And so I show different examples of these. And then if you get really different credits, you can set up multiple trade more contracts on one side than the other. Anyway, I'll be sending this out. Let's see, there's a second page in there. Yeah, if you get different credits on both sides and you just set the stop for um, 2 times the initial credit. Let me show that one in this other program. So let's say we get different initial credits. Let's say I'll use the 227 example here. Then what you don't want to do is set the stop here for 2 times the initial credit less 10 cents. That would be 330. Because if you got stopped out on that, you would have like more than $100 loss on that, what should have been a break even trade. And if that happens a lot, you could have, those losses could add up. I'll very often have a break even day and I'll make $400 or $500 per account. So that's why it's good psychologically because I'm at least taking a little bit home after spending all day trading. Even if I break out, even if I've stopped out of half of my trades, if we set a stop for on this side for 2 times the initial credit less 10 cents, that would be 260. Then I'm making $175. That'd be great. But you could use that technique if you wanted to. If let's say if it's a trending market and you don't know if the trend is going to continue, but you could take a little less credit. If it were trending up, take a little less credit on the call side than on the put side. And then if you stop out, you're stopping out with less losses than you're making on the other side. But the downside is that can work against you too. Sometimes the market could change and you stop out on this side and you lose $100. So that's what I'm trying to avoid with the M.E.I.C Plus. So in this case, you can do two things. You could either sell more contracts here, 5, and get those total credits. See, I've got 5 times 135 credit, 675 total credit on that side, and 4 times 170 or 680 total credit on this side. So those are very similar. So that means if I set my stop for 260 on this side, then I make my normal $30-$40 if I stop out on that side, or 330, I make my normal $30 if I stop out on this side. No matter which side I stop out on, as long as I just stop out on one side, I make a little bit of money. So let's just see what the market's doing. We had a little down move. 55. Let me see if we stopped out on. Nope, we didn't stop out on TAT. We had 44.55 there. And let me see where my trade is that we entered that single trade. Yeah, we haven't stopped out there. So I still have my single trade open. Should have entered more contracts of that. So let me write this down because I didn't get the legs on the puts. 45.45, 45.25. Okay. So this one, duplicate 80 and 45.45. So my lower leg is right in there on that trade that I entered. TAT's legs are different. Whoops, let me duplicate. It entered the 11 o'clock trade and got the 45.70 and did a 5 wide spread. So we're very close to the money with TAT. That's the thing about TAT. You can't control where it enters. Let me activate. And then you can only control the credit target. Now I am giving it a 45.55. So this is where TAT entered. I'm going to change the color of this to green so we can tell them apart.
Tammy, I have another question on that whenever you have a chance.
Sure. Go ahead.
But I might be jumping a bit ahead because I was in your previous class and
That's fine.
during my test in BYOB, the test you do from your Excel sheet, those are like 25 wide, right? And we aim for, let's
Yes.
say, 1.2 credit, 1.8 credit, 1.5, and 1.2 respectively, right?
Yes.
Now when I am trying to configure that, it has different options. It has a min and a max target premium, and your settings, the one at least you have, are variable from 5 width to 25 width. Now my question is, with this much variation, are you still getting the similar credit as you are running in your backtest and Excel sheets?
Yes, I'm using a credit target when I'm entering. So whatever means I have to do that, and that happens in TAT or manual trading. Whatever means I need to do, whether I go further out of the money in wider spreads or closer to the money in narrower spreads, whatever means I need to do to get the credit, it will do. And the back test will do that too, but it just won't change the strike width, the spread width. Now, there are some settings in there where you can set it like to use 20, 25, and 30 wide if you want, and or test 5 wide, but it doesn't vary as much as it does in live trading. And I get quite a bit of difference in spread widths on my trades when doing live trading. I can get the back test. I found that when I go back and back test a period that I have traded, that the back test results are pretty darn close to what I got in live trading. So I just tend to ignore the fact that the back test is using a certain width of credit. And so I might try testing 20 wide, whatever I use mostly. Usually I find that in live trading, I'm most often using a 25 wide, 20 or 25 wide. But lately I've found in TAT in the mornings, it does seem to be choosing these 5 wide spreads. There's a 10 wide for the put side. That's a 5 wide spread. But notice how close we are to the money on that one. And I'm nowhere, my stop is at 275 and the current price is 155. And let me call up that.
You're already in the money, actually.
Yeah, and so we're roughly at the same price we got in for, being that close to the money. Now, the stock hasn't moved closer. It might have come up, but I'll guarantee you, like I showed you, we could be in the money and I still not stop out on that strike, on that spread in a 5 wide spread. So I'm just trusting TAT to select the credits. Now, I have just recently started trading mornings because of the backtest results. The afternoon trades are not showing as profitable as the late afternoon trades, are not showing as profitable as they used to. And so this trading in the morning is a little bit new to me, and I'll just share my experiences with you. But it looks like TAT is most often getting these tighter spreads. I have it set up where it can use anywhere. Let me open one of my templates. Like I have anywhere from a 5, 10, 15, 20 to 35 wide spread. Most often it's choosing these narrower spreads, which is fine with me because of when I've observed how they behave, they do tend to keep me in trades longer. So I'm fine with them doing that. Really, it's all about the credit. It's all about where I am. Now, if I got $1.48 credit and was a little further away from the money and a little wider spread, I would probably like that trade better. That's probably in manual trading. I would probably do that trade rather than a closer to the money trade, because it doesn't take much movement to get to here, but to get up to that 70 price. We'll see what happens the rest of the day with this. If it got to probably 75, 78, that one would definitely stop out. But 45.75, 45.78. But as it is, we're still in that trade. We're still in all of these trades. So it's been good so
I think one thing I took home from this is I have my setting at 25 and 20, so I should probably widen my range too in that in paper trading for testing. Uh, Also, one thing that just jumped at me while I looked at your configuration is in your Excel sheet, the results shows that it backtests best on 1.2, 1.8 credit. Any
uh,
reason you have that set at 1.2 to 1.6 instead?
no reason. I just wanted to have a variety. Yeah, you could do your test with different credit targets. That's fine. Yeah, I just wanted about 30 cents between. I do have from 220 to 180, there's 40 cents, but I think the rest of them I have 30 cents difference between 220, there's 40 cent difference, and then 30, and then 120, 30 cent difference. And if I went 55, there'd just be slight, or 60 even, there'd be slight differences. It'd be very similar. So I wanted these to be different enough so that I get different results.
I see.
But I also I want to look at one of the reports I do looks like generally the higher credits do better in the morning and the lower credits definitely do better in the afternoon. So this chart takes the best of any of the time frames. This 219 car is really good. 100 car is really good. So those definitely made it into that chart. But some of these, like here, the 180 credit performed better at the 833 or 933 entry than the 220. So this chart pulls the best of any of these and lists it here, and then lists the credit: high range credit, mid range credit, low range credit. And then if they're all negative. So here you can see this is new. Used to, these time periods were gold. Like the 215 time period, you could make money on that every day. But lately it started testing negative across every credit. So that's why I say things change. You can't just use the same credits all the time. Now, if you look at longer time frame, like this is a 3-year time frame, all the credits are positive. So in the long run, you could select 5 or 6 times in a day and trade that all the time. And sometimes it's just always going to stop out, and then sometimes it's going to do well. But it all balances out in the end when you look at a longer time frame. I'm just trying to figure out, and I'm still working this out. There's no way to predict what's going to happen in the future. It's interesting to me that in the 6-month time frame, and this started happening in May, this is when this started happening, the midday really were all negative. And now,
like short term, we are trying to optimize for the current
yeah,
market conditions or VIX or whatever we can call it. And long term, it balances out at the end.
yeah. One of the things I do when I'm doing these tests, this is the 1 month period, November 1st to November 30th. This is the 6-month period. And then this is the 3-year period. One of the things I do is take all those and average them, so that I look at all of this, the average. And again, you can see if you average those periods, none of them is negative. So any of them, you can make money on any of those time frames. Some of them perform better than other times. And that's what I'm trying to do with the times that I'm choosing to optimize. So there's my 11 and 11:15 trade. I actually entered at 10:45 on that one account this morning. But if you notice, that only works on these higher credits. The lower credits, like 150 max, it doesn't work as well. In fact, you get some negatives in there for the lower credits in midday. And again, here doesn't work as well. You get a few negative in there. So these results I post on the Facebook, Quantum Options Facebook, and the Quantum Options Discord under the M.E.I.C updates on Discord. And I'll send you links to those. Someone's asking, Austin's asking, have you ever closed for a percent profit? I will say I don't do it on a regular basis, but if something's happening, or if it just seems the market's been calm all day, and then all of a sudden it starts acting really weird, I might close my trades early, just discretionarily close them. But when I have back tested closing trades for 90% profit or 75% profit, it just always performs worse than leaving the trade on till expiration if you do that every day. So I think you could close trades early for discretional reasons, and it'd probably be okay. But I try to follow a set of rules and just leave them on till expiration most days. Now that gets me in trouble sometimes. Yesterday would have been a good day we were in here and just flat most of the day. And I was profitable in my accounts at this time. But then when this happened, I got stopped out on all of these trades. And I was slightly negative yesterday. I think I lost one account. TAT I won. I made $500. One account I lost $500, and the other account, my bigger account, I lost. I was down one more loss than the number of wins that I had. If I entered 10, 12 trades, I got stopped out on 7 of them and won on 5 of them. So that creates a losing day. So it wasn't horrible, but it was okay. And regarding tightening stops, yes, I do. I will tighten my stops toward the end of the day. And I did yesterday. I'm debating with myself about that, and I'll explain my debate, and you can make your own decision about whether you want to tighten stops or not. Like in this case, it's trading in a range and these options are just decaying. Usually I will tighten the stop about the time that I take the long leg off of the stop. So I'll look at, and most of the time that trade is going for about 20 or 30 cents at the time that the long leg that I take the long leg off. And what I'll do is if the short leg is worth 20 cents or less, I will set my stop for $1. I don't usually tighten up to even tighter than that, because if let's say I tighten the stops on these, or I'll use these as an example because they didn't stop out. These, I could tighten those up to 50 cents, and a move like this might stop those out at 50 cents. But if I leave them at $1, most of the time at the end of the day, they won't hit that dollar strike. It'd have to be at the money before that trade was worth $1. So that's generally why I use that dollar tightening at the end of the day. But that sometimes I'll tighten if the trade is worth 30 cents, then I'll tighten to 3 times that credit. If the short leg is 30 cents, I'll tighten it to $1.20. And that gives it a little more room. I'll never go higher than my original stop. I'll always tighten it. So sometimes on these low credits, I have to watch out for that. But this trade yesterday, I had tightened these. The downside of tightening is if I left these at a 2x stop, I debate whether those would have stopped out and ultimately would have expired worthless. They did stop out because I had tightened my stop. So they went in the money and they were worth more than $1, so they stopped out. But if I'd left the stop on at 2 times the initial credit, those might not have stopped out and then it went down. But what I've observed is the last 15 minutes of the day, the bid-ask spreads widen considerably. So you can stop out faster, or if this kept spiking, you can get into a sizable loss much faster because of gamma at the end of the day. So that last 15 minutes is tricky. I would almost rather close when I touch that strike and just be done with it, so I don't have to worry about it spiking further. Now, that dollar stop probably saved me here because I didn't stop out. Keeping the stop at 2 times the initial credit here would have worked on these trades as well, because I know it never would have hit 2 times the initial credit, being 5 points away or so, maybe 3 points away at 10 minutes till the closing bell. Those would have been almost worthless, and it might have gone up to 50 cents or so. I do tighten my stops. I have next week we'll talk about backtesting and TAT. And I know a lot of you are interested in learning how to do this automated trading. Chris asked, which performs better, automated or live trading? Overall, live trading trades better. I've had better results in live trading than in automated trading, but automated trading is a very close second. I'll have differences in performance just based on entry times and you can enter a minute apart and get different credits and have different stops, and one will stop out and one won't. There's always a little variation in how different accounts perform, but the automated trading has it, like if I think I've made about a 35% return, or close, or maybe 32% return in one account, and 31% return on account this year so far in the other account. In TAT, it's probably 30%. So it's explainable within the normal range, the differences of the entry. But it sure is a lot less stressful when I know, and I wasn't sure about it when I first started it. Like, how does it handle stops and what does it do? And am I sure it's going to get me out? I've been trading with it for a little over a year, and I know it works, and it works really well. I haven't had any just weird glitches with it that haven't worked. But it's a whole lot less stressful because I just know it's going to get me out when it needs to get me out. It's going to follow the rules. And if you've ever heard people talking about trading with rules versus trading discretionally, basically any set of rules you can trade with, you'll get better results trading with rules than you will trading discretionally. So just in general, it's the same thing with TAT. TAT is the most automated, and I love it for that because I don't really have to think about it. I just record what it does each day. And we can watch. It looks like I did stop out of that last one and got 15 cents of slippage on that one too. Yeah, so I'm a little, even with using the M.E.I.C Plus, because of the slippage, like 10 cents there, 15 cents there, and 15 cents there, I'm still, and the differences in credit, I'm a $9 underwater. That's not a problem for me, but it's nice when it's $9 in the positive, but it's close. That slippage is the one issue I have with, and it's not TAT's issue, it's IBKR's issue. It's how they handle stops. And I don't understand, and I probably need to talk to them. I don't understand how their stops are different than E-Trade stops. E-Trade, I very rarely have slippage. Sometimes I'll have 5-cent slippage. And in a worst case, and we get a big red candle, then I might have 10 or 15 slippage in E-Trade. But where was I going here? Here. If we had a huge red candle, I could get some slippage, because between when the order gets placed and I get filled, there can be some slippage in there, but very rarely in E-Trade. So I think that explains the difference in results between TAT and manual trading, is just that slippage. Always when you're back testing, include some slippage in there. And if you're back testing, comparing it to TAT, I would include 15-cent slippage on exit. I don't know that you really need to include slippage on entry, but on exit, you can include slippage. But next week we'll go over back testing and trade automation toolbox and get into some things there. And with Trade Automation Toolbox, I have it set up on a remote server so that it is, excuse me, always active and always accessible. Because if my internet service goes down at my house, which sometimes it will have little blips, then the stops always reside at Interactive Broker. So any trades that I had entered, even an E-Trade, any trades I had entered, if I have a stop on them, that stop will activate if it needs to. But if I lost internet service, then this remote service is, they're at a data center somewhere and backed up and redundancy. So it should not go down. But what would happen if TAT went down and couldn't connect to IBKR is just these, let's say it disconnected now. I've completed 3 orders, so those will remain and the stops will remain at IBKR. But these future trades and any end of the day management that I have, it will stop. It won't continue. And I wouldn't enter these future trades if I lost connection. So that's one reason I have it on a remote server. And I use Windows 365, I think is what that is. Let's see if it says here somewhere. I don't know. Maybe not. Yeah, I think it's Windows 365 is or maybe Microsoft 365. Maybe I have that wrong. So if you want to use TAT, that's one recommendation. I would just recommend setting it up and setting your, putting IBKR access on there. And that's basically all I have is Trade Automation Toolbox, the Trader Workstation from IBKR, and that's it. And on this server. And then it's very easy to go between the servers. Just minimize this. It just acts like another window. Okay, Austin asks another question. What's the credit target for the afternoon trades? Is it for the last 3 hours or last 2 hours? It depends. I will just look at an options chain and if I can get $1.30 credit in the afternoon, like I will do it. Here to get $1.30, I'd have to go to this 10 points or 15 points out of the money and then select one of these. But it just depends on what this credit is doing on the options chain. If I can get 125, I'm good. 130, I'm good. If I can get 140 in the afternoon because volatility is high, I'll get it. And as long as I look at a chart, like what the chart is doing, like these trades are doing fine and they're pretty close to the market, 10 points away now, and this one's 5 points away. There, it looks like that's where I was stopped out of this one, but I'm still in my trade, in my manual trading. I think I haven't heard that it stopped me out. TAT, let me call that up. I do have it set because often I will only be able to get reduced credit, like somewhere around 120 or so in the afternoon. So at 12:45, usually or after, I'll have it set up for $1. And when I was trading late day, like 12 to 30, 2:45, this is all central times, 2:30 or 2:15, I might even go down to 80-cent credit that way. And that way I'm not right at the money. I'm maybe 10 points out of the money. But again, I've noticed that those lesser credits do tend to stop out faster. I also hate to trade right at the money. And it's almost like doing a fly. So anyway, we're coming up on 2 hours. I've been doing a lot of talking. Hopefully that was helpful. Okay, I think that's it. We'll call it a day. Good luck.
Appreciate you guys. Have a great week.
Okay. Bye-bye.